You're tuned in to True Crime Stories.
The numbers tell most of the story. When Carillion entered compulsory liquidation on the 15th of January 2018, it carried liabilities of almost £7 billion. It had just £29 million in cash. In the previous financial year, it had paid a record dividend of £79 million and large performance bonuses to senior executives. Those three numbers should not coexist. A company that hands out $79 million in dividends is not a company with $29 million in the bank facing $7 billion in liabilities. Unless something about the picture being shown to the public was not actually true. Carillion was a British multinational construction and facilities management company headquartered in Wolverhampton, created in July of 1999 following a demerger from Tarmac. It grew through acquisitions to become the second largest construction company in the United Kingdom, and in 2016 had 43,000 employees, 18,000 in the United Kingdom. It built hospitals, it built roads, it ran school meal programs, it maintained military housing, it held over 450 public contracts. If a Briton ate a school lunch, drove a motorway, or recovered from surgery in the late 2010s, there was a reasonable chance Carillion had a hand in it. And the entire structure was hollow. In the 8 years from 2009 to 2016, Carillion paid out £554 million in dividends, 3/4 of the cash it made from operations. In the 5.5-year period from January 2012 to June 2017, Carillion paid out £333 million more in dividends than it generated in cash from operations. Read that twice. The company paid out more cash to shareholders than it actually made. That difference has to come from somewhere. It came from borrowing. Over the 8 years from December 2009 to January 2018, total loans owed by Carillion increased from £242 million to an estimated £1.3 billion, more than 5 times the value at the beginning of the decade. While Carillion's debts rose by 297%, the value of its long-term assets grew by just 14%. The borrowing was funding the dividend. The dividend was funding the share price. The share price was funding the bonuses. 2 mechanisms kept the appearance going. The first was an accounting choice. Percentage of completion accounting lets a contractor book revenue based on how complete a project is estimated to be. If you're optimistic about your estimates, you book the revenue early. If those estimates turn out to be wrong, the loss arrives later, often much later. In the end, Carillion was estimated to have £1.57 billion worth of goodwill on its books, a value that didn't actually exist. The second mechanism was the supply chain. Carillion was known to make its suppliers wait over 120 days for payment. The company then abused the supply chain finance scheme, launched by the government in 2012. Through this scheme, suppliers could take their invoices to partner banks and be paid in advance for a fee, while the debt would transfer so that Carillion then owed the money to the banks. It used this system as a line of credit, yet did not account for it as borrowing on its financial statements. The debt to small contractors quietly became debt to banks. The balance sheet looked cleaner than it was. Investors were not entirely fooled. In early 2015, UBS claimed total debt was higher than Carillion was publicly stating, triggering a large increase in short selling of Carillion shares. 3 years before the collapse, professional short sellers had already done the arithmetic. the internal warning signs were louder. A November 2016 internal peer review of Carillion's Royal Liverpool Hospital contract reported it was making a loss. That was November 2016. On the back of the 2016 results, Carillion paid a record dividend of £79 million, 55 million of which was paid on the 10th of June, 2017. 1 month after that dividend went out the door, the company issued a profit warning. On the 10th of July, 2017, Carillion announced its profits would be hit to the tune of £845 million, and the bonuses had been protected. In 2016, Carillion changed its pay policy to relax clawback conditions for executive bonuses. Previously, the firm could ask for cash back if the business went bust. The revised policy said it could only do so for gross misconduct or if results had been misstated. 6 months after that profit warning, the company was finished. Government meetings continued throughout the weekend of the 13th and 14th of January, covering £900 million in debt, a £580 million pension deficit, and many ongoing government contracts, but broke up without a rescue deal. The Financial Times later reported Carillion had just £29 million in cash when it collapsed and would have run out by the 18th of January, 2018. The wreckage spread quickly. Debts of almost £2 billion were owed to its 30,000 suppliers, many of whom received little back from the liquidation. The government had to commit around £150 million in taxpayers' money to keep essential services running. Carillion's pension liabilities totaled £2.6 billion. The parliamentary inquiry that followed did not soften its language. Carillion's rise and spectacular fall was a story of recklessness, hubris, and greed. Its business model was a relentless dash for cash, driven by acquisitions, rising debt, and exploitation of suppliers. It presented accounts that misrepresented the reality of the business and increased its dividend every year, come what may. Long-term obligations, such as adequately funding its pension schemes, were treated with contempt. Even as the company very publicly began to unravel, the board was concerned with protecting generous executive bonuses. The mystery is not that it collapsed, but that it lasted so long. The accountability came late, and it came small. In early 2026, former Carillion Chief Executive Richard Howson was fined £237,000 by the UK Financial Conduct Authority. This followed similar fines issued weeks earlier to former finance directors Richard Adam, £232,800, and Zafar Khan, £138,900, for misleading investors. £600,000 in fines 8 years after the collapse. KPMG and Carillion bosses had maintained a £329 million valuation of goodwill relating to the former IEGA business, despite huge losses. Ignoring the impairment meant they could continue to pay dividends and directors' bonuses, including £1.8 million each, paid to Richard Howson and Richard Adam. The question the Carillion case forces is not whether the directors broke the law. The question is what the system was actually rewarding. A company that paid out more in dividends than it earned for years, while the pension deficit grew and the supply chain was used as a hidden credit line. That company was rated green or amber by the Cabinet Office for most of its final decade. The auditors signed it off. The board approved the dividends. The bonuses were protected by rewritten rules. Carillion did not collapse because the system caught it. It collapsed because the cash finally ran out. if you were running the regulator in 2015 when the short sellers were already circling? What would you have needed to see to act? Leave a thought in the comments. The